Financial services giant Investec has warned that full-year earnings may have dropped by as much as 27% due to a drop in principal transactions, and the news sent the company's share price down about 3% lower at the close today to 47.65. For more insight into this, we're joined in studio by Stephen Koseff, the Chief Executive of Investec. Thanks very much for your time, Stephen.
Pleasure, how are you?
Looking at the pre-close investor briefing that you came out with today, take us through what ultimately is the headline information that we should take away.
I think the first thing is, we've been reporting every second month, so this information should have been in the market. I think what some of the analysts missed was last year we had a debt buyback in February, which we made £32 million on, which has to go into earnings from an accounting point of view, and it's a real profit, which was not repeated. But for us, obviously we said in September we're restructuring part of the Australian business. We closed the property lending business down completely and we're clearing the assets, and that obviously had quite a big effect on these numbers. Investment banking activity is a lot slower. Mainly, you've been sitting in an environment where Europe was, up until maybe last week, very wobbly, and that slows down economic activity and deal activity, and so investment banking therefore slowed down quite significantly in this particular year. The other area we had to do increase a provisioning on a rundown mortgage book in Kensington, where we had to change some of the assumptions on defaults because we gave forbearance to clients, which is government policy that you give forbearance to clients. In the other part of government say, well, if you're giving forbearance, you've got to regard it as a default as opposed to a performing loan. So those are the three things which should have affected us the most. And
so we shouldn't have seen the knee-jerk reaction that we saw today.
Yeah, I think in the UK we were down about 1%, which was a lot of other shares were down 1%. Here we were up before the close, and then people sort of thought, oh God, 22 to 27% is a big number. It's
without actually looking at the detail.
12 to 16% at the operating level. But then we've got more shares in issue and we've got a slightly higher tax rate, or a higher tax rate than last year. So that means that the EPS level is 22 to 27%. But yeah, we're at the back end of clearing from the crisis.
Stephen, if you look at what's been going on in Europe with the LTRO, those wonderful loans at 3-year loans at 1%, and what's happened to banking stocks around the world, US up 20%, Europe up pretty good as well, banking shares here up nicely.
Yeah.
Do you think this is the darkest before the dawn, this situation with regard to Investec?
Well, I think if you look at, European banking stocks or American, I'm talking about in our space, they had horrible years last year, going to the end of September. I mean December. They made quite a lot of them made actual bottom line losses. Some made big losses in the quarter, September to December. Goldman Sachs had a 3.7% return on equity. Most of them are sitting, I think Barclays was 5% return on equity with targets up at 15 level. So what the rally that you're seeing is because people are saying, okay, the bad news is getting behind us and that the world is stabilizing. But prior to that, if you saw from July to December, banking shares got badly. I mean, they're mostly still down between year on year, 10 and 30%, depending on who you pick. Yeah. So, when you sit just in South Africa, you say, oh God, why is Investec reporting negative where the other guys are all reporting positive? But you've got to look at the business models and look at where we operate, and we're in a totally different cycle. And I think that's not clearly understood by even South African analysts.
Being compared.
Well, you can't compare it because our South African business is flat year on year. We expect it to be flat. If I look at some of the other banks, their investment banking sides of their business that really compete with us were down. So you're not comparing like with like. You can't compare Investec, where it's got half its capital in England and Australia, to a South African bank which has 95% of its activities here or in Africa. It's a totally different place.
And Stephen, I mean, I think what a lot of analysts are concerned about is the Kensington book and there's exposure to Europe. Have you, I mean, is that pretty aggressively provisioned? Do you see the worst is through that, and could we see quite a rapid turnaround?
Last year Ireland had that bubble where it burst, and we provisioned 55 to 60% of your loans have been written off. And then you never lent 100% of the value in the first place. Irish house prices are down by 55%. So we factored all that into our provisioning. So we think that, you know, we're pretty well provisioned. This Australian book that I'm talking about is now at clearance value, and we're busy moving the stuff out. So we really taken the thing and said, okay, it's time to clear anything that's hanging around.
In terms of Australia, what do you expect going forward from an economic perspective?
Well, we've got a private banking business there now, which is very similar to our original business in South Africa. That's quite profitable. That lends money to accountants and doctors. We have a corporate finance investment banking type business, which is now profitable. And we, as an example, one of the large mining groups in South Africa bought an asset in Africa that was owned by an Australian corporate. Our South African and Australian teams together advised that firm in that acquisition. So, you know, there's a lot of traction and cross-border flow between the two entities. And then we have a capital markets business, which is similar to our capital markets business in South Africa and London. It's younger and it's newer, but it's, you know, it's profitable and it's gaining traction. And I think that when you strip out this particular issue that we had, Australia will be quite strongly profitable. The
So
ROE
the
is not at the right level
remedial
yet, but it's still strongly profitable.
And the remedial action, as you say, is done. It's finished.
Yeah.
But Stephen, excuse me, a bit of a tricky question now.
Sure.
I'm not trying to catch you, but a tricky one.
No, you can try and catch
A lot
me.
of South African companies have had this issue. Do you sometimes wish you'd never gone overseas, apart from asset management?
No, but if you remember, and I remember talking to you some years back on the old JCR thing, and I shouted at you in an analyst presentation, and I'm going back 9 years, when we went on roadshows, then people saying, well, you know, you make breaking even with asset management in London.
Yeah.
What do you have it for? Why don't you say? In fact, they said we were making losses. Yeah. I can remember a number, £3 million. Hendrik says I'm talking rubbish, because he's never made any losses anywhere. But let's agree with Hendrik for a second, we were breaking even. Today, that business manages just the London side, £36 billion. It makes, at the moment, £65 million pre-tax of a business that those same people told us to sell. So we've got to run our business at the end of the day. We know that, yes, we made mistakes, but we got caught up in a massive financial crisis. I mean, it will go down in history. It might not make the words depression, but certainly it's going to be called the Great Recession, and books are being written about it every single day. It was a massive global event, and that if you are operating in that environment, you know, when you sit in the UK, and I can tell you, I can name them, 7 out of 10 of their mainstream banks, apart from an HSBC and a Standard Charter, which are not UK banks, are operating in global markets, actually had to, in the case of a Barclays, sell Barclays Global and get a lot of capital from the Middle East. But the rest actually went out. They didn't survive.
Did you go to the European window the other day for those loans, the LTRO loans? Did you borrow?
Yeah, we always can play at the European window because we can get some money cheaper than other money.
Those 1% loans for 3 years.
Yeah, we took some of that. We didn't take the first lot, but I mean, it's a gimme. You've got to try and take it. But you've got to have the assets. So we had to basically buy German bonds to take to the window to get the cash, and now we have to find replacement assets.
Stephen,
but that's helped the system a lot.
Yeah, very much.
Yeah.
You speak of the wealth management, the asset management asset within the group, and it is doing incredibly well. Are you going to continue to see aggressive growth in this arena?
Well, we try as hard as we can. I think that the asset management business is in a good space. You know, it's very well run, and it's got 2 what we call manufacturing platforms where they manage the money, Cape Town and London, and then they distribute their product set right throughout the world. And that is working very well. I mean, they get money from sovereign funds, from governments, from all over the show, in all different locations. In South America, even in the US, we distribute product into the US. You know, Australia, we get money. We've got quite a lot of money we manage in Australia, a couple of $2 billion already. We've only been there a few years. So it's really, you know, getting a lot of traction, and has been also perhaps a beneficiary of the dislocation, because so many other guys messed up and they didn't mess up. The wealth management business, we now manage £36 billion, mainly between London and South Africa, and now it's a question of how we take that, what asset management did, and roll out the wealth management business into a more global entity. The bank is where we've had to do a lot more work, because that's the industry that's really been beaten up. You've got much more capital that you're required to hold, much more intrusive regulation, much more liquidity. And as a consequence, that is going to affect ROE and how the bank looks going forward, and therefore we have to spend a lot more time and effort, which we are doing, in creating the right kind of banking model, apart from the fact that we have some legacy books that resolve from the crisis that we have to get out of our system.
And bringing it back to South Africa, the private banking arena in South Africa.
Yeah.
Traction starting to
Yeah, no,
come to
that's
the fore?
turned.
That's fine. It's
not
out of the woods completely.
It's nicely profitable, but not where it should be yet. But next year it's on the way again. It's like a 2-year blip and then we're back. And now, obviously, we have to compete. We've got some oaks barking up our tree, and so that's a competitive place. But now these seasons are good for you because you hone in and say, get going again, guys. You're living on your laurels.
On that note, thanks very much.
Thanks.
Stephen Koseff, the Chief Executive of Investec. We look forward to talking to you again, sir, on the 17th of May when you announce your results.